From Barangaroo Studios, the ausbiz COB is the key stuff you need to know about the day in business and finance.
Hello and welcome to the COB on this Friday. I'm Andrew Gagan. Thanks for joining us as we unpack the day and the week and just checking where we're at on the local index. We're off about 0.5% on the day's trade, and for the week we're actually up around 0.33%. That's on the ASX 200, of course, having hit another record high yesterday, but just falling back from that in today's trade. It takes us to our themes of the day. It is a Friday funk, ending on a negative note, ending the month, it would seem, on a negative note at the same time as we now head into December, of course, all considerations there. Rates pushback, we're hearing from more banks and houses there pushing back their calls for a rate cut. ANZ and now AMP pushing their bets back to May next year from February. And yes, hello December, goodbye November as we enter the last month of the year. Seasonally, it is normally a very positive month, but just questions, I guess, given we've had the Trump trade, perhaps also questions whether Santa Claus rally is already upon us, just whether we can continue that momentum, particularly given that markets, including our own, are at or near record highs. All right, let's just check the sector to see how we're tracking as we round out the week. And healthcare is proving to be a bit of a drag, led by CSL, which is down more than 1.5%. The one that's bucking the trend there is Ramsay, which is up slightly. Elsewhere, the bank's also proving to be a large drag. NAB is down more than 1%. And the Commonwealth, which was up about 1.5% yesterday, has eroded some of those gains today. Also, Macquarie is down close to 1.5%. And the miners, that other large sector, of course, that dominates, is largely positive. BHP, Rio and Fortescue all in the green. Mineral Resources also making some small gains there. Let's catch up with the top stories of the day. Ampol tipping its 2024 capex will be $650 million following an update on operations at its Lytton refinery in Queensland. The Select Harvest has posted FY24 profit of $1.5 million, rebounding from last year's loss of close to $115 million. Well, let's take a look at the day and the week that was, and welcome Shane Oliver from AMP. Shane, good to catch up with you again on a Friday, as we always do. Let's first start with your rates call. You've now moved that to May. Why have you made the move?
Well, I guess for some time now, and there's been a lot of debate about it. Many other economists have already moved. I think we're lagging a little bit on this one. To be honest with you, I think there is still a strong possibility we could get a February move, but the commentary coming out of the Reserve Bank, obviously a week or so ago in the minutes, and then overnight from Reserve Bank Governor Michelle Bullock, suggests that it's not in a hurry to ease. So consequently, we took the call only a few hours ago to shift that move from February to May. It's not one that I'm particularly comfortable with. When I look around the world and compare us to other countries and look at core inflation measures or underlying inflation measures, we're not really that different in terms of the amount by which we exceed our target compared to the UK, New Zealand, US, Canada and so on. But by the same token, you have to accept that the Reserve Bank is the ultimate arbiter here, and it makes the call, and it still sounds relatively hawkish. And of course, I mean, as I said, it's still possible you could get a February call, but I think you'd have to get something like a 0.5% quarterly rise in the trim mean for the December quarter to get that. We get those numbers late January, and we'd probably also have to see quite a significant rise in unemployment to bring on a February cut. And as things currently stand, that seems possible, but probably not probable, and therefore we made that move.
Shane, what's the chance that when Donald Trump walks into the Oval Office on January 20th, that the world could change? Look, anything is possible, I guess, under a Trump presidency. But what potentially could happen that may warrant either the RBA to leave rates on hold or perhaps pull them forward? And because a lot of this depends on global trade. Given what we learnt or heard from Donald Trump this week, the threat there obviously of imposing 25% tariffs on Canada, Mexico, another 10% on China.
Well, yeah, that's going to create some bumps. There's no doubt about that. And he's talking about those tariffs from day one. I tend to think they probably won't start from day one. He will give those countries some time to respond, to negotiate. There was an occasion back in 2019 when he announced 25% tariffs on Mexico, only to remove it all or backflip a week or so later after he had negotiations regarding immigration with the Mexican president. So I suspect we'll see something similar this time around. It's going to create bumps. Of course, there's others who argue the other way, that it'll be the tax cuts and deregulation which will actually boost growth and therefore result in a somewhat more inflation-prone world than the tariffs alone, which could actually be a bit of a drag on growth. So these things can go in all sorts of directions, and they do add to uncertainty. I tend to think, if anything, you probably want to be easing ahead of that to shore up the economy, because I tend to think that Trump, if anything, will be a negative influence on our growth outlook compared to rather than a positive influence. But by the same token, the Reserve Bank may argue, well, it's still early days yet. Easing in February is too early. Mind you, we should note that this year, the first meeting of the year won't be the first Tuesday in February. I think it's the 18th and 19th of February, so it comes later in the month. And therefore it'll get a lot more information by then. We'll be almost 1 month into the Trump presidency by the time the Reserve Bank actually meets again. So you can't rule out. I mean, they could go in February. I reckon the odds of going in February is higher than the market puts it at, which is 30%. It's probably something like 40%. So that's certainly possible. It's also possible they could go in April. The Reserve Bank reforms were passed into law last night. The Treasurer will no doubt have the new interest rate setting board up and running by the time of the April meeting, which actually starts in late March and then runs into April 1st. April Fool's Day, I guess it will be. And of course, it's quite possible that there'll be some more soft on inflation, softer economists on the RBA rate setting board, which could then bring on an April rate cut. That's possible. I don't think that would be good for RBA credibility if that did occur, but you can't rule that out. But of course, we don't know which way that one's going to go either. So that's why we sort of settle on the next one, which is, of course, the May meeting, which is what most economists do. They tend to focus on the meeting that has the update forecast from the Reserve Bank.
Meanwhile, shares continue to march higher. What are your observations with the equity markets at the moment? Because we hit a record yesterday. Again, US markets remaining at or near record highs. Got a good lift there too from Donald Trump's nomination for Treasury Secretary in Scott Bessent.
Yeah, there's this mix of positives and negatives out there. It's the negatives which keep everyone a little bit cautious. So this is not a sort of a euphoria bubble in markets that we're seeing. It may become that, but we're not quite there yet. And you can see in our market that sort of zigzag pattern. It sort of goes up, then pulls back a little bit, then goes up again to another new high and pulls back a little bit. In some ways, you could say that's relatively healthy. Obviously, the negatives are the fact that valuations are stretched, that bond yields are relatively high, geopolitical risk is high, the tensions in the Middle East remain significant, and of course the tariffs coming from Trump and the uncertainty about how much the Fed will cut and when the RBA will start cutting. So they're all the negatives. The positives, though, are that Goldilocks seems to be lingering for longer, particularly in the US. So that helps the US share market. There's optimism about stronger profits ahead in Australia, that arguably we've seen the worst and that growth might pick up a notch and that'll be good for profits. And ultimately, central banks around the world will probably continue to cut interest rates. So that sort of keeps markets going. But it is, I think it's going to become rougher as we go into next year. Just before I came on, you mentioned seasonality. Seasonality is typically positive around this time of the year. You get the year-end optimism, whatever it is. You can see it on that chart there. It typically kicks off in October in the US. We can be a little bit later, although that chart there is influenced by 80/70. If you strip that out, then we tend to see strong Novembers as well. So, we are into a positive seasonal period for markets, and that continues at least into January. Then you go through a bit of a softer patch and then strength into April and May. So that helps markets as well. But I think investors, when you're looking at this, you have to allow, well, we've had a, 10% gain on our market this year, 15% if you include dividends and franking credits, 25 odd percent in the US, other markets somewhere in between those. That's a pretty good return, particularly after last year was quite strong as well. So you have to assume that things are going to slow down eventually. And I tend to think next year will probably be okay for markets, but it's going to be a lot more constrained and probably a lot more volatile than what we've been seeing, given all those risks, particularly around Donald Trump.
Just looking ahead of the next week, we've got some data out of China tomorrow in terms of a particular focus on manufacturing. Jobs will be the focus in the States, and here at home we get that September quarter GDP read.
Yeah, we do. The PMI's out of China tomorrow. I don't know why randomly sometimes they end up on the weekend in China. Sometimes they're even on Sundays, but that's the way it is. Those numbers will probably remain okay. There's been a little bit of a edging up lately, but from soft levels in those PMIs, and that may reflect the stimulus in China. But interesting to see with this one, though, because it relates to November, and it may reflect sentiment regarding the election of Donald Trump and the tariffs. So that'll be interesting to see. In the US, I think the key is the payroll numbers on Friday. They'll probably show a bounce back after the weather affected the numbers for October, with just a 12,000 rise in payrolls. You'll probably see a gain of about 200,000. But with that, we might see a slight edging up in the unemployment rate to 4.2%. I think if that's the case, no big impact on the Fed. But it will be consistent with an ongoing slowing in the US labour market. We also got some numbers on Tuesday in the US, what they call job openings and quits. And I think the trend in those will remain down, warning the US labour market is still cooling off. And of course, in Australia, we get a lot of data next week. It seems the ABS has much of the month off, and then it gets to the end of the month or the start of the new month, and they release everything at once. And of course, we've got the GDP numbers on Wednesday. They'll probably show a slight lift in the quarterly rate to 0.4%, but the annual rate will stay around 1%. In other words, still pretty soft. Consumer spending sort of basically flat, I think, or slightly up very slightly, if at all. So nothing great there. In fact, that's going to remain pretty weak, particularly once you allow for population growth, which is still falling, still strong. So per capita consumer spending still falling, per capita GDP still in recession, business investment probably providing a bit of a lift, and net exports also helping. But basically showing the economy is still pretty sluggish as we come into the end of the year.
Shane, always great to unpack the week with you and what's ahead. Thanks for joining from AMP. Had a terrific weekend.
You too, Andrew. Take care.
Cheers. Okay, let's head to our stock of the day. That was Findi, the fintech company, reaffirming its guidance after reporting a $3.9 million net loss in the first half. The stock tumbling around 25% today. Adam Dawes from Shaw & Partners and Junbei Liu from Tribeca had a look at the stock.
If you're a growth company, you can't just sit around and say we reiterate guidance. You have to upgrade, because there's so much of that price baked into that growth to happen. Obviously at the AGM they didn't say that. I think they said the second half's going to be a little bit more, a bit lumpier, so that's going to struggle. So I think it's just a little bit of heat now coming out of the stock. I was on the call 2 weeks ago and I said it was a hold. Now I think overall I'm going to call it a sell. I just don't think that overall.
Look, if I'm looking at the chart, I definitely think it's a sell. And look, to be honest, it is very, very speculative. It's a company actually has attracted a lot of attention because it's interesting. It's rolling up ATMs in India. Yeah. And there's massive amount of opportunity. Even the cash is growing at 15%, and not to mention a lot of people don't even have access to all of bank accounts and others. So incredible amount of growth, and then they're rolling it up. But I think the thing is that you need to be very close to management because they are doing business in the emerging market, right?
Okay, let's check the market leaders and laggards in this Friday trade. Webjet and Web Travel, the company have a split, of course, both at the top of the list there, up more than 7% and 5% respectively. Telix Pharmaceuticals also doing well. Sigma Health now with Chemist Warehouse on board among those doing well. Whereas on the negative side, Auckland International coming off almost 3%. Paladin continues its volatile ride. It's down more than 2%. And Credit Corp similarly, along with the Liontown and Mirvac. Just in terms at the small end of the market, let's check in on those that are moving. Patriot Battery Metals up 15%. Also in that space, Lavtora Resources and elsewhere SmartPay, Paradigm higher. Findi, as I mentioned there, the worst performer today, down almost 25%. And some of the others in the resource space, including this Energy, Burgundy, Bougainville and Canyon. So let's take a look at what's on overnight, and we do have the Eurozone November CPI, and also the Bank of England Financial Policy Committee meeting minutes will be released. And in terms of what's ahead, we get retail trade growth, GDP growth for the September quarter, that will be released next week. We also get some more RBA speak. CoreLogic's Home Value Index for November and the Melbourne Institute's inflation gauge. And offshore, China Acacia Manufacturing and Services PMI, that's going to be released tomorrow. Also, the key read in the States is all going to be about jobs, non-farm payrolls, JOLTS, and we get the Fed Beige Book, as well as some ISM manufacturing and services indices. Also ahead next week, Cyber Monday. If you can, your chance essentially to join some of your favourite ausbiz analysts as they present their stocks on sale. They are equities they say are undervalued and offer significant upside. That is Monday, the 2nd of December at 11 a.m. Eastern. You can register for free to watch live or on demand at ausbiz.co/cyber. So just recapping the market where we're finishing up on the CBO, almost 0.5% lower, just checking the ASX 200. It is down around 1/5%, almost 1/4% lower, but for the week, it's up close to 0.4%. Stay with us, the last call is up next.